Some of the best performers year to date are utility companies such as Constellation Energy, Vistra Corp, and GE Vernova. If you take a look at the past 3 months, some of the best performing stocks are uranium mining companies. So what I want to talk about today is what's going on, why is this happening, is it likely to continue? And I also want to take at what I think is a very similar case study from about 15 years ago that we can take a look at. So first of all, why is this going on? Why are these utility companies, which usually don't really lead a strong market, why are they taking pole position? Well, the reality is the biggest technological revolution we've seen in many, many years is the AI revolution. And the reality is as powerful as these AI models are, you actually need a lot of power, physical power, electricity to be able to power the data centers that perform all this computational work. And so a lot of big cap tech has seen that, hey, if we're going to keep being able to grow our data centers, we need access to massive amounts of stable power. So there's been a very large infrastructure build out that's taken place, in all of these companies that support this infrastructure build out have benefited substantially. But interestingly, over the past 3 months, there's been a lot of strength in uranium mining companies. Now, nuclear energy for a long time has been an industry in decline. Ever since the Fukushima disaster in 2011, there's been just less and less interest in nuclear energy, and there's some countries such as Germany which have closed a lot of their nuclear plants. But this sudden demand for clean, consistent, and sustainable power around the clock has forced a lot of technology companies to kind of relook at the industry, and they're focusing on what's called small modular reactors. These are reactors that are much smaller in scale. They're not the typical large plants that we've come to know for nuclear power plants, and they're looking to use these to power some of their specific data centers. Now, before we go into the specifics of the nuclear trade and what I think is developing, I want to take a moment and look at one, what is typical for commodity prices, and two, what's a really good case study we can look at to have an idea of what to expect. So first of all, commodities typically don't have big trends. A commodity is a commodity for a reason. It means it's readily available, and there's typically some relatively consistent demand and supply. That changes when there's a shock. It could be either a supply shock, where suddenly, let's say there's a very large new supply of the material is found, prices will fall rather dramatically. We saw that in 2014 with crude oil, when the shale revolution in the United States began a much bigger amount of production of oil, that oil prices really fell aggressively. But sometimes there's a demand shock. There's suddenly a new demand for a mineral, for a commodity, and that leads to a very, very big upside move. I believe that's what's happening with the uranium right now. But normally, this is not the case with commodities. You need some kind of shock to kick off a dramatic advance. Most producers have fixed costs, and typically there's fixed supply. Supply doesn't come on very quickly. So if there is a demand shock and prices go up, that can typically lead to some pretty dramatic increases in earnings for these companies, because you just can't get a lot more supply all of a sudden. So if you are one of the few suppliers, you're able to command much higher prices for your product. And that usually, with your fixed cost, that usually means a dramatic increase to your bottom line. So that's why the potential is very large should it develop that way. So what's possible? I want to take a look at the 2006 to 2008 rally in fertilizer stocks, potash stocks. There was a number of similarities, and what's interesting is we can go back in time now. We can kind of look at an interesting article from Investment Executive where they kind of break down the case study, but they broke it down in real time back then. We can look back now with hindsight, and we can kind of pull out the very key elements that are not always so clear in real time. But first off, before we take a look at that article, let's take a look at this chart of fertilizer prices from CRU. You can see that fertilizer prices more than tripled in just 2 years. And so, it may seem odd to expect such a dramatic move in a commodity, something as simple as fertilizer, which is used every day in growing crops and all the rest. But under the right conditions, there was a dramatic boom in that commodity. And that led to staggering 1,000% plus moves in the stocks in that group. So if we're looking at the uranium sector today as having a potential similar setup, we want to understand what can the stocks do and what were the real conditions that led to such a sizable advance in such a short period of time for something that should be a relatively boring commodity. So let's take a look at this article by Investment Executive. It's entitled, "Tight Capacity and Rising Demand Will Drive Up Potash Prices." This is from July 28, 2008. The first interesting thing is if you take a look actually at Mosaic, which is one of the companies we'll study, this article came out touting all of this kind of situation way after the move had already happened. So, I mean, prices had already peaked, things were heading lower, and they were late to the game. So it's difficult purely from a fundamental perspective to always be able to time these things. That's why I really like to come together with both technicals and fundamentals. And really, that way you can manage your risk, and you can also look at what price action is saying to give you a sense of what's possible. I've covered all of this recently in my membership at carusoinsights.com. I've personally been positioned a lot of these uranium stocks for a while, and these are the discussions we really have on the platform, going beyond the fundamentals, going on beyond the charts, and how we bring all of this together. But looking at this example, I want to pull out some interesting parts from this article that highlight the key components that I think really lit a fire under the fertilizer stocks during that period. So first off, there's no real substitute. So the fact there's no substitute is, for example, if let's say beef prices get expensive, people can eat pork, they can eat chicken. In this case here, to grow these crops, they really needed this potash, they needed this fertilizer because they needed to grow these crops. And so if you look at this article, they say potash is a potassium-rich organic product mined from deposits left behind when the water in ancient seabeds evaporated, and there is no commercial substitute for it in fertilizer used for crops. It is the high prices of agricultural commodities that are driving potash prices higher. So that's an important element. So we're looking at the current situation and we want to know, is there a substitute? So point number 2 is that there was a new catalyst. If you put yourself back in time to the mid-2000s, you'll see from this article that the growth in the biofuels industry has also boosted potash prices, as many of the common biofuels, including palm oil and ethanol, are processed from crops that use potash as a fertilizer. Several countries, including Canada, have already implemented or are considering legislation that would force oil companies to blend barrels of fossil fuel with 5 to 25% biochain. So that was really the new catalyst, this new demand that really hit crops, whereas crops up until that point were really just for food consumption. Suddenly they became part of energy. Now, this part is also important, where we discuss how there was a very fixed supply of this potash, and it was a very long dormant industry. This is going to have very close parallels to uranium. So you see from the article, they say another factor driving prices higher is the lack of supply. You had a period of about a decade when there were very few potash mines brought on stream, and some were even taken out of production because prices did not justify them, she says. Because it takes a number of years to bring a new potash mine into production, supply is probably going to remain tight for the balance of the decade. So interesting, and we'll get to that in a second, but the fact, like I mentioned before, with commodities, supply doesn't just come online. There has to be a thoughtful process. There has to be capital to be invested. There has to be environmental clearance. There has to be the actual supply that is found in nature. So it takes time. And if you're coming from a period of time where there was a very low demand, nobody's going to spend the capex to bring these mines into production. So if there's a sudden burst of demand, prices have to go up to fill that void. So let's take a look now at the nuclear uranium trade, and let's look at the similarities. Now, I don't know for sure if this will follow a similar path. Like I said, the fertilizer prices more than tripled in just 2 years, but we have a lot of similarities. This is a case study, and all we can do is, we never know the future, is really look back and try and look at parallels, learn from the past, and apply them in real time. So if we look at the uranium business, first of all, there's, I think, a big demand shock. If we take a look at this chart from UEC, you can see the number of technology companies just in the past month or so that have committed to using nuclear power to power their facilities. Now, these technology companies are the biggest companies in the world. They're leaders in many things. And I can tell you, for the rest of the world, if people want to remain competitive, well, the cost of energy that you're using to drive your data centers is an important element to what kind of work you can get done and at what margins. So if this is something that's worthwhile for these tech companies to be doing, this is not going to be the end of this trend as this starts to develop. So now, looking at the industry itself, we've had a long dormant industry, very similar to the potash business. And like I mentioned before, after the Fukushima disaster in 2011, where we had the problems in Japan with the meltdown of the nuclear reactor because of the tsunami that hit, nuclear energy was a no-go. People did not want it. Like I said, not only did Japan close many of their reactors and have been slow to bring them online, countries like Germany have also brought down their reactor usage. New planned reactors have been set aside. And that really put a lot of weight on uranium prices. Not only did demand fall off, but a lot of these facilities who had excess supply were selling their supply on the market, and that really drove down uranium prices. So much so that Cameco several years back was throttling back production at their mines and simply buying uranium at the spot price to fulfill their contracts. So this long dormant period, similar to potash, meant that there has been no increased investment, significant increase in investment in the industry for many, many years. And we're also, interestingly, running into a sudden demand shock, I believe, with this demand for all of AI in the data centers. Now, one other interesting spin, and I didn't spend a lot of time talking about in fertilizer discussion, but for fertilizer business, there's only a couple of countries, Canada being one of them, that make up the vast majority of potash supply in the world. That's very similar for uranium. If you look at uranium, Kazakhstan, which is located right near Russia, it's formerly part of the Soviet Union, they produce 43% of the world's uranium. Rosatom, which is Russia's nuclear monopoly, holds a stake in 5 of Kazatomprom's 14 deposits and receives 20% of the country's output. Now, 43% of the world's production. If you look at Saudi Arabia and the oil market, which is always touted as the big player in the oil market, they only have 11% of oil production. In fact, all of OPEC together has about 40% of oil production in the world. So Kazakhstan alone has a bigger weighting than all of OPEC does in oil. That's the size of the market that Kazakhstan controls. So when you look at this, similar with fertilizer prices, you start to have to work into the equation, if there is a sudden new demand, that there's also going to be geopolitical tensions. And American companies who are part of this new demand shock, they may want to make sure that their supply comes from, let's say, friendlier nations, or nations that are not located so close to Russia or whatnot. So that will have a big impact, specifically, I think, on the demand supply for Western uranium providers. So I think that adds only an added boost to its potential for companies like Cameco and UEC. Similar to the whole potash setup, there's no substitute for uranium. Like I mentioned before, with potash, they need that to grow crops. With uranium, you need uranium to power your nuclear facilities. There's no other element. You can't, substitute, oil or crude oil or some of it. It has to be uranium. So if this demand comes online, there's no substitute. So if you see, we have a very similar setup between what happened to fertilizer prices in 06 to 08 and what I believe is going on with uranium right now. Now, again, I'm both someone who studies fundamentals and charts, so it's interesting to also look at the comparison of what was one of the leaders in the space back in 06 and 08, Mosaic, MOS. What does that stock chart look like compared to Cameco today, CCJ? So if we bring up this chart, you'll see that they both had clear long downtrends with a clear climax bottom. They spent a number of time recovering the worst of the drop and then consolidated sideways with a very similar 4 waves of volatility contraction before pushing higher and forming a new basing structure. Mosaic, we don't know what comes next for CCJ, but even from that point, if you only walked into the story at that point, Mosaic still rallied another 600% before it hit its peak. So as you can see, kind of from a fundamental perspective and a technical perspective, there's some really glaring similarities. Now, I've been positioned in the space for some time. I took immediate action when I saw some of the news of how Microsoft had reopened 3 Mile Island, which is the big nuclear facility in Pennsylvania. That to me was a really sizable change of character in the space. Like I said, this was a space where it was always which plants were closing. Suddenly we had a reopening of a plant. But I still think it's early days. I still think we're working on a similar base structure like we saw in Mosaic back in 06. I think that we're in the midst of a prolonged advance. But I think it's particularly important to look at a case study like this because from someone on the outside looking in who doesn't understand the dynamics of that sector, it would seem odd to expect a very large move in a commodity like uranium. Similar to how someone who didn't understand fertilizer prices, it would be odd to expect a tripling in fertilizer prices out of nowhere if you didn't understand the bigger developing situation. So now nothing is ever exactly the same. There's always going to be different dynamics. We don't know to what extent the demand shock will continue. We don't know exactly to what extent we can bring on new supply in a short notice to kind of meet. But if we look at price action, there's been quite a bit of strength. The general charts look very similar. And if you look at a company like CCJ, they've already been able to grow earnings per share. This should only further accelerate that should the trend continue. In fact, the CEO of CCJ, which he's been CEO for many years, also during the mid-2000s when uranium also went on another kind of massive advance, he recently said this is the best fundamentals he's seen in uranium in his 40-year career as an industry veteran. So putting that all together, that's the nuclear uranium case. That's how I've kind of come to my conclusion to want to establish a position in the industry. I'm always a risk-first investor. Should prices fall and break below my cost, I'll probably exit and look for re-entry. But from a kind of top-level view, from a bigger picture of what's possible, I'm using that 2006 to 2008 as my base case of what to expect. And of course, we'll have to adjust as new information comes to us daily and weekly. I wish you all great trading. You can follow me at trader_mcaruso on X. You can also visit me on my website at carusoinsights.com, where we discuss topics like this twice a week on video calls, daily market updates, and a whole host of other features that I think you should take a look at. Thanks for your time. Talk to you soon.